Friends, thank you once again for tuning in. Is your host none other than Mr. Spotter Fred. Remember, Mr. Spotter Fred is a PhD fellow, and I'm happy that you are tuning in for today's session. We are looking at today's session being for financial reporting. We are simply looking at a topic under financial reporting known as branches. We can say accounting for branches. We are looking at financial reporting, accounting for branches. Or we can simply say branch accounting. That's important. Now remember, when an organization has grown too large, they will always sell their goods and services through various outlets. These various outlets, friends, listen to me carefully, these various outlets will be referred to as branches. So branches is simply the outlets which are used by the organizations to sell their goods and services. Now, we may have various types of branches. Let me say types of branches. Types of branches. One of the branch is dependent branches. We have dependent branches. We have dependent branches. 2, we have independent branches. We have independent branches. 3, we have foreign branches. We have foreign branches. Now, when we talk of dependent branches, these are like selling agents. They receive goods from the head office, they sell the same goods, and they remit cash on a regular basis to the head office. So dependent branches are non-autonomous branches. They don't maintain the books of accounts. While when it comes to independent branches, they maintain their books of accounts. They can even get supply of goods from other sources. Don't forget that. But they prepare their financial statements, and these financial statements can be combined by the financial statement with the financial statements of the head office. When you talk of the foreign branches can either be independent or dependent. Now, foreign branches is a scenario whereby an organization may have a branch outside the reporting country. For example, if an organization is in Kenya, we may have a branch in Tanzania, Uganda, we may have a branch in Rwanda, we may have a branch in China, Britain, and all that. Don't forget, it's very, very common. Even now, we have been having branches in Rwanda. We have been having branches of various organizations in Tanzania and Uganda, even in China. Now that we are doing trading business with we are really engaging so much with the East, you realize that we may also find ourselves having branches in China, or China being the home country having a branch in Kenya, and Kenya becomes their foreign country. That's exactly something happening. I know of a friend of mine who is doing some business in Kenya, and he has a branch in China because of some trade that I may not want to say, but is a legal business that he's doing, and he has a branch in China. So that's what's happening. And one thing you need to remember, when you have a foreign branch, the transactions at the foreign branch will be reported using the foreign currency, using the function of foreign currency. So we are going to be required to translate the foreign currency to the reporting currency. We translate the Uganda shillings to Kenya shillings. We translate the Tanzania shillings to Kenya shillings. So that's what we are going to do. So we are saying that these dependent branches are autonomous, non-autonomous. Independent branches, they are autonomous, while foreign branches may either be autonomous or non-autonomous. And in most cases, foreign branches, they're actually non-autonomous. That's something very important we are going to look at. Now, we start with the dependent branches. Let's say one, dependent branches. Dependent branches. Dependent branches. The dependent branches, this branch is like a selling agent. A selling agent that sells goods on behalf of the head office and remit cash on a regular basis to the head office. They do not maintain their own books of account. They do not maintain their own books of account, meaning the books of account that will be maintained will actually be maintained by the head office or at the branch by the head office accountant. That's what we're going to do. What are the books of accounts we are talking about? Books of accounts. One is the branch inventory account. This can also be called the branch stock account. This one is maintained at selling price. Branch inventory account is a control account. This control account will be reporting, or rather recognizing, the goods that we are receiving from the head office and the goods that we are sending out or we are selling from the branch. So inventory account is a control account, just to safeguard the inventory of the branch of the head office at the branch. This means that we are going to open a branch inventory account, and you will always debit the branch inventory account with all the goods that are being transferred to the branch. Any increase in the value of stock will be debited in the branch stock account. And any decrease, maybe we have sold some goods have been stolen, some goods have been damaged, some goods have been returned back to the head office, they will be credited in the branch inventory account, but at selling price. So the branch inventory account will be debited with all goods received from the head office of any increase in the value of stock, and will be credited with all decreases in the value of stock at the branch. The balance carried down in the branch inventory account will reflect the closing stock, but at selling price. So that's important. We are going to look at that again. Number two, we have the branch markup account. The branch markup account. The branch markup account will also be referred to as a branch adjustment account. Remember, this one is maintained at profit loading. This one is maintained at profit loading. So we in the branch markup account, we recognize that account in using the profit loading, except one item, the normal, the normal losses. If you have a normal loss at the branch, that one we are going to debit the branch markup account with the selling price. This branch markup account or adjustment account is effectively a trading account. The balancing figure in our branch markup account will be our gross profit or our gross loss. That's important. Then we come and talk about number three, the goods sent. Goods sent to branches. Goods sent to branches account. The goods sent to branch account, this one is maintained at costs. This one is maintained at cost. The goods sent to branch account will be reporting all the goods that have been received at the branch and all the goods that have been sent out of the branch. And that will be reported at costs. The balancing figure in our goods sent to branch is head office purchases. That's a control account as well to determine the head office purchases held at the branch. Important there. Then number four, we have the branch debtors account. The branch debtors account. This is maintained at actual price or actual transaction value. The debtors account, a branch will have their own customers as well. So they will maintain a branch debtors account, especially to the transactions, to the credit transactions between the branch and the customers. Now, if you sell goods on credit, you will have to debit the branch debtors account. If you receive some cash from the credit customers, you must credit a branch debtors account. If you are going to write off, or rather some bad debts to be written off from branch customers, you have to credit the branch debtors account. If you are going to give them the discount allowed and what have you, it must go through the branch debtors account. So that's important, not something very new. Then we come and talk about number 5. We have the branch cash account. The branch cash account. Remember, the cash account is to maintain or to recognize the receipts and payments. We are going to debit a branch cash account with all the receipts. Either we have received cash by selling goods, we have received cash from our customers, from our credit customers, we have received cash from other branches. We are going to credit a branch cash account with the payments. Either we have made payments to, we have done remittances to the head office, we have made payments for the expenses, we have maybe done other payments in respect to the branch transactions. So in that case, we are going to recognize that through the branch cash account. Now, without forgetting, we have the branch memorandum, trading, profit and or loss account, This is the profit and loss account that we want to determine whether we have made a profit or a loss at this branch. So we prepare a memorandum trading profit and loss account. We can simply start with the gross profit. We don't need to start with the trading account. We can do the profit or loss account, whereby we are determining the gross profit from our branch markup account. So we start from the gross profit, we less the expenses. Alternatively, we can simply start from the beginning. The sales, we less the cost of sales, we get the gross profit like that. But the gross profit we have to get in the trading account is the same gross profit that we must have got in our branch markup account. Now, friends, something that you should also remember, or I need to remind you, we have talked about the branch inventory. We have said that the branch inventory is maintained at selling price. One thing you need to remember, let me say, the pricing. We have said that the branch inventory is maintained at selling price. You need to remember that the selling price is simply the cost plus the profit loading, Remember, in the branch markup account, we are maintaining most of the items at profit loading except the normal losses, which we recognize as selling price. So when we talk of the profit loading, the profit loading is simply either we can take the gross profit margin, you multiply the selling price, or profit loading, we can take the markup, you multiply the cost of sales. That's what you need to remember. Is either selling price, or we can say sales, or cost, we can say cost of sales. So you need to remember that we cannot take the gross profit margin, you multiply the cost for you to get the profit loading. Or you cannot get the profit loading, simply the gross profit. This is just simply the gross profit, nothing new. So that's exactly what you need to remember. How do we get the costs? The cost is simply, you can take 1 minus gross profit margin, you multiply the sales or selling price. That's something that you know is not something new. You can take the gross profit margin, 1 minus the gross profit margin, you multiply by the selling price or the sales, you get that. Now, let me remind you this. How this comes in when you talk of the gross profit margin. When you talk of the gross profit margin, friends, we are simply talking about the gross profit. you divide it by sales. I can even call it selling price, no problem. I multiply by 100. Alternatively, I can just say gross profit is simply the sales. I say the sales minus the cost of sales over our sales. This means that we can even go further and say that our gross profit margin is equals to the gross profit over cost of sales plus gross profit. If you take cost of sales plus gross profit, it will give you sales. So this, in other words, you can say it is A over B. A over B. Oh, sorry, A over B plus A. Yeah, that's important. That's important. So this means that if you take, e.g., let me say e.g., if our gross profit margin is something to do with 25%, is the same as a quarter, then our profit loading, we are saying our profit loading will definitely be a quarter, you multiply the selling price. Then in that case, you need to remember the costs. The cost of sales is 75%, which is the same as 3 over 4. We can also say that our selling price is equal to 100%. If you take, if you simply come and say, we are talking about costs plus profit loading, we are simply talking about 175% plus 25%, which is 100%. That's not something that is so difficult. It's something we are able to get. This profit loading, we must have got it this way. If you want to get your costs, if you want to get the costs, you can simply take 1 minus profit loading, that is 1 over 4, and that's how we were getting 3 over 4. Now that's very easy. You should be able to know that if you have been given a margin, you can be able to come back to the markup. If you're given a margin, you can use that margin to get the markup. But if you're given a margin at 25%, for example, then that's the profit loading is a quarter of the selling price. Our cost will be 75%. So you take, if you want to get the cost price, you take 75%. I can come and say 75%, you multiply the selling price. If you take 75% of the selling price, that will give you the cost. Then we are saying that the selling price is simply 100%. The costs, in other words, we must have got it by taking 1 minus 1 over 3. If you take, 1 minus 1 over 4. If you take 1 minus 1 over 4, you get 3 over 4. If you take 3 over 4, you multiply 100, you simply get 75%. That's important. So this is what you should know. We are going to talk about the markup. How can you come from the margin to move on to the markup? So on that note, let me move on to the next side. I say, we are still talking about dependent branches. We are still talking about that. So we are saying about the profit loading, about the markup. How about the markup? How do we get the markup? The markup, we simply get the gross profit over cost of sales, or just simply costs. I can simply say costs. You multiply by 100. This is the same as saying, if I take the selling price minus the costs, I divide it by the cost of sales, I multiply by 100. This is the same as saying, let me say also, the gross profit is equal to, if you take the sales minus gross profit, if you take sales minus gross profit, you get the cost of sales. You multiply by 100. So we are saying that if you take the sales minus gross profit is B minus A, and that will be giving you cost of sales. Now we can give an example, e.g., if a markup is, I can use the 25% is equals to 25%, which is a quarter. This means that this is A over B. Then what is our costs? What is our costs? In this costs is going to be 120, because the cost is going to be 100%, because on top of the cost there's a markup, a profit loading of 25%. So the cost is 100%. Then we have the selling price, which is the cost plus markup, and that is 100% plus 25%, which going to be 125%. So that's the selling price is 125%. Then we ask ourselves, what if you may use the other alternative? You want to get the margin. How do you get the margin? So margin, gross profit margin, is simply the gross profit over sales, which is the same as gross profit over cost of sales plus gross profit. Then we know that this is A, B plus A. And we know that A over B is 1 over 4. So 1 over 4 plus 1. Remember, A is not a constant of 1. You should remember. It's just a constant that we are finding that in this case we are saying 1 over 4, 1 over 3 or something like that. But A is not a constant of 1. A can be even 2, 3, 4. So A is not a constant of 1. So we have 1 over 5. And that is our margin. So you have seen how we can move from the markup to the margin, or how we could move from the markup to from the margin to the markup. So that's very important. So you can easily now use this information and be able to get what you are required to. So that comes to the end of just introduction of these prices. We were looking at how to get the prices, how to use the prices, and sometimes you're given the markup, you need to use the margin, or sometimes you are given the margin, you need to use the markup, or sometimes you're just given the markup. Even if you need to use the margin, you can still use the markup directly, and that's how to go about it. Now, friends, we want to look at journal entries, or rather accounting entries, in respect to the books of accounts, in respect to the branch inventory, branch markup, goods sent to branch, and what have you. So we want to look at accounting entries. Accounting entries. We want to look at the accounting entries. Now, as you can see from what we are downloading for you there, is that when you talk of accounting entries in the books of the branch, one, when goods are sent to the branch, we are going to debit the branch inventory, debit branch inventory with the selling price, and you credit the branch markup account with the profit loading. You also credit your goods sent to branch at costs. Number two, when goods are returned, the same goods may be returned back to the head office for 1 or 2 reasons. When goods are returned back to the head office, we just do a reversal of what we did. Number 1, we are going to debit our goods sent to branch at costs. We debit a branch markup account with the profit loading, and then we credit our branch inventory with the selling price. Number 3, when these goods have been received at the branch, they are going to be sold. They may be sold on cash basis or they may be sold on credit basis. If they are sold on cash basis, the branch has sold goods on cash basis, then debit the branch cash account, credit the branch inventory account. So we must credit the branch inventory account with the cash sales. With the credit sales, we are going to debit our branch debtors account. We credit our branch inventory account with the credit sales. Now, sometimes goods may be returned. Goods may be returned not by the branch to the head office, but by the branch customer. If a branch customer return goods, they have an option. They may return goods directly to the head office or they may return goods to the branch. If goods are returned to the branch themselves, it's easy. We simply debit our branch inventory account, we credit our branch debtors account with the selling price. If goods are returned by the branch customer to the branch, we debit our branch inventory account, we credit our branch debtors account. Number 5, if goods are returned by the branch customer directly to the head office, what are we going to do? We are going to debit a branch markup account with the profit loading. We also debit our goods sent to branch at costs. Then we credit our branch debtors account with the selling price. So far, friends, we have 3 types of returns that you need to remember. There are 3 types of returns. 1, the branch has returned goods to the head office. We have said that one you debit the branch markup account, you credit your branch inventory account. 2, when a branch customer has returned goods to the branch, we have said that you debit the branch inventory, you credit your branch